Okay, let's make a start. Well, yes, good morning, everyone, and thank you for joining us for our 2024 autumn budget webinar. The agenda is to run through those key areas. So the employers' national insurance is the first section, capital gains tax, changes and possible solutions there, inheritance tax, where my colleague Tom is going to talk about the changes and his thoughts on solutions. We've got a section on exit and session led by my colleague Marketa, and then I'll cover a few wrap-up areas on other budget matters at the end. So employer national insurance, where are we? The big headline grab at 1.2% increase in employer national insurance. So that's moving to 15% from 13.8 from April 2025. A couple of other threshold changes that came alongside that. So the threshold at which employer national insurance is payable on salaries is now £5,000 per year from April rather than £9,100. And the employment allowance, which is the deduction from the employer bill of NI for businesses, is increasing to £10,500. So a sort of giveth and taketh away moment there. Threshold going down, but the deductible going up, which is likely to have reasonable impact for small businesses. The employment allowance increase for larger business is certainly a fairly drop in the ocean type change. Also, some pretty steep rises in national living and national minimum wages, and also the proposal to provide guaranteed hours for 0-rate contracts. All of these things are basically going to make employees more expensive. And is there anything that can be done about that? The first point to mention is that different thresholds actually apply to different types of employees. So under 21s, apprentices under 25 and veterans, nothing's changed with regards to them for the thresholds for employer NIC. So it isn't actually until they're paid around £50,000 that any employer NIC is due. That's something to bear in mind. A little bit more niche is that employees located in free ports or investment zones, there's also a different threshold of employer NI for them, which is £25,000 per year. Appreciate that's quite niche, so do contact us separately if you want to know about the free ports and investment zone initiatives. So there is certainly a possibility that these changes could see an uptick in the attractiveness of recruiting certain specific demographic of individuals in the future. That point aside, what else could be done with your existing workforce? Salary sacrifice. This has been a useful way of saving national insurance in the past. It becomes ever more so now. It should be at the top of everyone's agendas, really. So correctly implemented salary sacrifice means that an individual gives up an element of their salary, but they don't pay employer and employee national insurance on that salary, which is given up, as well as obviously not paying income tax on it. Commonly, this is used for pension contributions, but HMRC's approved schemes include workplace nurseries, cycle to work, and electric cars. There's a few important points about what correctly implemented means. So an individual could reverse the choice at will, which means that needs to be a contractual adjustment to salary with a degree of permanence to that. There's also some watch outs in terms of not impacting individuals who might fall below national minimum wage or national living wage thresholds as a result of doing it. And in the past, there was certainly some concern about the impact on mortgage lending. I think now most high street lenders do understand the concept of salary sacrifice and don't provide lending based on the net salary. But that is certainly something that individuals will need to be made aware of and get advice on if employers are going to roll this out. How else can national insurance be avoided? I mean, there's some fairly obvious ones here. Dividends. No tax changes to dividends announced in the budget. but no national insurance is payable on dividends. So there's the back on the agenda again, if not every year, will need to be remuneration planning. That differential between paying tax on a salary versus paying tax on dividends. This obviously applies to individuals involved in companies, but certainly to look at the tax efficiency of extraction of profit needs to be considered. There's also a wider piece about do family members get brought in to take shares and then potentially have dividends out of the business. Again, that would in theory be free of national insurance. And certainly if it's wider than simply the family owning the business, equity plans for management is an incredibly tax efficient way of awarding and rewarding employees, and particularly if it's done through a scheme that's HMRC approved, which we help a lot of businesses with, can result in them receiving dividends themselves, but also having some sort of capital value payout trigger at a certain point in the future, which would be subject to, say, capital gains tax for them individually, which will save them income tax, national insurance, and also the employer national insurance you would otherwise pay on, say, a bonus. Certainly that is worth really thinking about now. A few of the fairly obvious points: partners and sole traders, that their profits are not subject to employer national insurance, so it's not applicable for them. It would obviously is applicable to anyone they employ, and also the fact that employer national insurance is deductible for tax purposes. So there is a sort of a small mercy I've described as there, in terms of it being deductible rather than fully taxable and a full cost. I think the overall message here is that national insurance isn't particularly easy to avoid, but there are certainly some strategies that can be used to soften and ease the financial impact of what is going to be a pretty significant change for businesses who employ a large number of people. That's the headline grabber in terms of the fiscal tax raise. I'm going to move on to capital gains tax now. The issue here is that changes were made with from the time that Rachel Reeves stood up. So these are already in play. Capital gains tax rates now 18% for basic rate taxpayers and 24% for higher rate taxpayers. There are exceptions and things like carried interest tax regime is probably not applicable to many people listening in. Capital gains tax, it was reasonably expected that something would happen. What was fairly unknown was what would happen to the 10% rate of tax, the relief for business assets, previously known as entrepreneurs relief, whether it was going to be scrapped entirely and immediately. That was one suggestion. Whether it would be scrapped from April 2025 or perhaps left where it was. We ended up with a bit of a middle ground, a bit of a hybrid of those things. So the relief remains in play, but it is going to be reducing in value over time. We actually have a short period of time where the relief is now worth £140,000, and that is up until the 5th of April 2025, which is more that the relief has been worth for 4 years, over 4 years, in fact. So the message is probably quite clear. If you have a business asset that you want to dispose of, now is the time to do it to secure that 10% rate. You don't have many months left, but that is enough time to execute a transaction, I would say, in general terms. From April next year, the relief will be worth £100,000, so back to the level it was pre-budget. And then from April 2026, the relief will be worth £60,000. Some really crucial points about the relief. So each individual taxpayer has access to this relief. It's not shared between spouses, family members, etc. So it is possible to structure family ownership of assets to enable individuals to potentially access the relief. Certainly do speak to us if that is of interest and that isn't something that you've thought about. Another thing that is worth mentioning, certainly with regards to shareholdings in companies, is investors' relief, a subject that's really rarely talked about, but actually is another relief sort of sitting alongside business asset disposal relief that gives a 10% rate of capital gains tax. It does differ to business asset disposal relief because it's intended to be for investors as opposed to employees and directors, and hence the name, I guess. But that is a separate lifetime limit of £1 million at 10% rate, which is now going to increase. The rates will increase in line with business asset disposal relief, but it is a £1 million threshold there, making it pretty valuable if you can secure it. What I also wanted to demonstrate is, as well as sort of flagging that there's still some months there to secure a 10% rate of tax, is there are actually plenty of areas where there's a zero rate of capital gains tax. So not to get lost in the weeds of what's going to happen with the rates of CGT, zero rates exist in many areas of the tax regime. So particularly with relating to share sales, there was a lot of talk prior to the budget that the government would go after sales of shares because they thought that the rates were too generous. And in theory, they have, tackling business asset disposal relief and indeed limiting investors' relief as it was. But I've identified 5 areas where you don't pay any tax at all. The first being a disposal of shares to an employee ownership trust. So this is a government-approved share ownership structure intended to sort of model the John Lewis business idea of individuals within the business, employees collectively owning the business they work for. If you were to sell your business to an employee ownership trust, which applies for trading businesses, then you pay no capital gains tax at all. There's a number of conditions, and in fact the budget did tweak some of the rules, but it is an increasingly popular way of looking at succession to your business if you want to sell it internally, as it were. There's also 3 government improved investor targeted reliefs. So the enterprise investment scheme, its younger sibling, the seed investment scheme, which is for smaller businesses, and venture capital trusts, all of which result in no capital gains tax being paid on the disposal of shares, subject to meeting the various conditions. The advantages with those 3 regimes is that you also get upfront income tax relief. And in the case of seed enterprise investment scheme, that income tax relief is 50% of the investment. So huge opportunity there to minimise income tax, as well as avoiding the so-called increases in capital gains tax rates, because there's a zero rate there. And finally, ISAs, again, pretty obvious, but there's no capital gains tax on disposal of shares within an ISA. So plenty of areas for individuals to consider how they structure their affairs in a pretty tax efficient way. There's plenty of other reliefs that enable you to defer or roll over gains made on assets so that you don't have to pay the capital gains tax up front. So actually, with some careful planning, the increase in rates of capital gains tax perhaps are not going to be as significant as would otherwise feel. That's what I'm going to talk about capital gains tax for now. I'm going to pass over to Tom, who will talk about the seismic changes introduced for pensions and also with inheritance tax.
Thank you, Steve. Yeah, I will talk about that shortly. Just to say, I hope everybody can hear me. Those of you that were early on to the webinar today, probably would have got an introductory message from me, which may have been a little bit quiet. I'm afraid that was user error. I had inadvertently plugged in my headphones but wasn't using them, but hopefully now I am audible. So if I click the relevant buttons, I'll get my slides up. So I want to talk about, well, pensions and APR and BPR, which I guess really are sort of separate entities in their own right, but they all kind of fall under the banner of inheritance tax. So what are the inheritance tax changes? The first is around pensions. And so from the not too distant future, pensions are now going to be brought into one's estate and potentially liable to inheritance tax. For APR and BPR, so that's agricultural property relief and business property relief. These reliefs were sort of designed to allow businesses and agricultural businesses as well to be passed down through the generations as succession planning for family trades. These are now going to be lumped together and subject to a £1 million cap. £1 million can still be passed down tax-free. Anything above that will be subject to tax at 50% prevailing rate. So that's currently 20%. Specific rules relating to AIM shares, which are kind of high risk. We don't do a lot of that within Old Mill. They have no £1 million allowance, so they're straight in at 20% tax. And this all comes in a year before pensions in 2026. So when I'm talking about pensions, I'm talking about defined contribution pensions or a pension fund or a pension pot. So this is opposed to final salary schemes, if you're lucky enough to have one of those, or any sort of salary related scheme. They're not impacted the same way. There are rules around pensions on death at present, but these sort of relate to income tax. That's saying that depending on the time of death, then potentially pensions are taxable to income tax in the hands of the beneficiary. And this also applies if the pension is large, over £1 million or just over. And we do expect those rules to still apply. Which I think is going to make pensions less attractive than they were before, albeit they're still effective as income tax vehicles and still effective as ways of extracting funds from a business. But in terms of what happens on death, well, there is a consultation announced between now and the introduction of the rules in 2027. And I would hope that that consultation sort of irons out some of the problems that we can foresee with adding pensions into an estate. The first is probably around how any inheritance tax is paid. So inheritance tax should be paid within 6 months. The way the legislation is drafted, any inheritance tax applying to pensions is going to have to be paid by the scheme trustees rather than the executor. There's already pressures on the probate office, so I'm not entirely sure how this is going to pan out. So there are some issues there. The calculation of the inheritance tax itself could become more complex. Pensions coming into the estate, we think they're going to therefore impact on the residence nil rate band. So this is an additional allowance that applies if you are the owner of a house and you wish to pass that house on to your direct descendants, so kids or grandkids, which is 90% of the population. That allowance can be tapered away when estate is valued above £2 million. And with pensions now contributing to that estate figure, I think we're going to see more allowances tapered away. One small crumb of comfort, I think, is that if you happen to benefit from a life insurance plan, so a group death in service, where you may receive 3 or 4 times your salary, or your estate will, if you're unfortunate to pass away whilst you're working, we think that's outside of the scope of IHT, but otherwise pretty much everything is captured by the new rules. So to run an example, I've got here, mum and dad, they own a house and some cash. They own a business and they have a pension. And the way it stands today, if unfortunately they were to pass on, they have various allowances that they can set against the value of their estate. So they have a nil rate band each, and they have a residence nil rate band each. So that will give them £1 million worth of allowances. And they have their business or agricultural business, and that will qualify for BPR. So that can pass on without tax penalty. And they have the pensions, which are outside of the estate. So as it stands today, kids are due to inherit the full value of their estate, £3 million in this example. Where we go from April 2027, the nil rate bands will still apply, but the residence nil rate bands are now gone because of the impact of the pensions coming into the estate. The total estate is now worth more than £2 million, more than the taper threshold, so the taper is taken away. BPR still applies in this example because it's capped at £1 million, but the pensions are outside of the estate. So the taxman is going to take just over £500,000, leaving the family with just under 2.5. I think this raises a question as to how tax will be paid. So at present, with pensions being outside of the estate, they can normally be paid out discretion of the trustees on the provision of a death certificate. The full probate process does not have to be completed. So for a lot of estates, the pension fund can provide liquid funds to settle any inheritance tax liability. That's not going to happen in future, the way the rules are drafted at the moment. And in this particular example, it would be an issue for this family because they've got £200,000 worth of liquid cash, funds available, but the liability was over £500,000. So what can you do about it? I think before we get too carried away, remember planning principles. So why are you using your pension in the first place? If it's for all the good practical reasons that pensions were sort of introduced into the UK tax system, that is, tax efficient way of saving, building a pot from the future, extracting funds from your business, these still apply. So unless you have maximised your pension allowance for £1 million already, and depending on what stage of life you're at, actually funding pensions can still be the right thing to do. I don't think you want to throw the baby out with the bathwater, but that's not to say that this doesn't cause an issue. And I'm conscious that over the past few years, panelists such as myself have been highlighting the tax advantages of pensions, and there will be many of you out there that have pension funds of significant value that you were sort of earmarking for a tax-free legacy for nearest and dearest. They're no longer going to be tax-free. So what can you do about it? Essentially, it's around using the funds more efficiently, specifically for inheritance tax. So if you think of your entire assets, your entire estate as one, you'll have various pots that attract various different reliefs and have different treatment for inheritance tax. And the pensions are now going to fall under the category of no inheritance tax relief. So if inheritance tax is your objective, it's about accessing the relevant funds, which could include your pensions, to do something more inheritance tax efficient with those. Certainly that means withdrawing the tax-free lump sum. 25% of your pension pot can still be taken tax-free as the rules stand. Ever since that was changed, the name of that was changed from tax-free cash to the pension commencement lump sum. Rumours have been rife that allowance will be taken away, but for the moment it remains. And then there may be an opportunity to withdraw some income, accepting that if you're a higher rate taxpayer during your working life or an additional rate taxpayer, you'll get higher rate or additional rate tax relief on contributions going into a pension. In retirement, you're not likely to be earning more than you are whilst you're working, so you may well be paying a lower rate of tax. In which case, a little bit of tax along the way might be palatable if it allows you to do something more effective for inheritance tax. Essentially, withdraw some income, pay 20% tax, help resolve a 40% inheritance tax problem. Okay. So moving on to agricultural property relief and business property relief. I'll put the statement up there as to why these reliefs were introduced in the first place, because I wanted to kind of draw a contrast with the pensions. As I saw a slide or two a moment ago, there are lots of reasons to still fund a pension, and pensions are fundamentally to allow people to build a pot to have an income in retirement. Okay, APR and BPR not the same. These reliefs were introduced for succession planning. Okay, one important point about the new legislation, which personally I think is a little bit out of kilter with the objectives of the reliefs, is that the APR and BPR allowances, effectively the cap has created allowances, are not transferable between spouses. Therefore, if you had a say family business, but it is only owned in the name of one partner, then there is only £1 million allowance available. So to highlight the impact of this, again, another example. I didn't go to art school, by the way, despite these fantastic diagrams, I'm sure you'll agree. At present, we've got a couple that own a business. For the sake of illustration, I'm saying it's owned by the husband in the partnership. He owns a business which is valued at £5 million. If he was unfortunate enough to pass away, likelihood is that the business would pass to a spouse, and this is still okay for inheritance tax because it's covered by the spousal exemption. So the business is still worth £5 million at this point in time. No liability has come into being. And then it passes on to the kids. And because it qualifies for BPR with the current rules, that's fine as well. And the kids now have full control of the business at the full value. Jump over to April 2026, same scenario, business worth 5 million. Husband unfortunately passes away, goes to the wife. If wife then passes away, the first £1 million is the allowance, so that can pass to the kids. But the other £4 million, the value of the business, has to go via the taxman. Taxman's going to take his share, £800,000. Thank you very much. And so the kids get a business that is now worth 4.2 million, or rather, they've got to find £800,000 from somewhere to have control of the business. One of the thoughts we had about how you might mitigate that would be the use of trusts. Certainly, that can be an option to ensure that both pairs of a partnership make use of their £1 million allowances. But as you can see from the table on screen, the rules around trusts are complex, and there's also not a lot of detail available in the legislation as stands. I actually caught up with our tax team in preparation for this webinar to get their input on things, because they're very much the specialists, and tax specialists, as you may imagine, they are detail-driven people. They thrive on black and white, absolutes, right and wrong. And particularly with the application of the new rules around existing trusts that may hold APR or BPR qualifying assets, the legislation is quite light. So on the table there, that is our sort of understanding of how we think things will apply. So I don't think there's going to be a retrospective entry charge. Could potentially be periodic charges and exit charges if the value of the trust is such at the time of the 10-year anniversary, and then on exit, and then potentially additional inheritance tax to pay. So APR and BPR, what can be done about it? I put in part. I'm afraid I don't think there's a silver bullet. There's nothing that can be done immediately, but there are some strategies that can hopefully help soften the blow. And with collaboration with your advisors and proper planning, it still may be possible to sort of make the best of the situation, really. The first, I think, is really making sure that if you have a family business or a family farm, is understanding that the £1 million allowance is per person, not per business. It's not transferable automatically the same way a nil rate band is. So it's making sure that those £1 million allowances are used on first death, and on second death, so that the business benefits from £2 million worth of allowances. So we may well see an introduction of kind of carve-outs, specific provisions in wills, akin to the old nil rate band trusts that are still prevalent in a lot of old wills before the nil rate band was transferable. And I think that's going to be really important going forward. So as a sort of immediate action, I would suggest, if you're in this situation, is to review the will, review the structure of the business or the farm, and see what can be done there. I also think there's going to be a need for more lifetime gifting. So potentially little and often, but moving the ownership of an asset from one person, a matriarch, patriarch, onto the next generation in a more planned and coherent fashion than perhaps is the case at present. Of course, that's going to transpire over time. As I say, it's not a silver bullet, but I think that's going to have more say in how businesses and farms are passed down generations. And the other thing, I suppose, is once the business has significant value, a bit like I said, strip funds out of the pension, do something else with it, strip funds out of the business and do something else with them, if possible, of course. Traditionally, the best way to strip money out of a business is to make a pension contribution. So you can see my little light bulb has now gone out. As we've just seen, pensions are in the scope of inheritance tax. So if inheritance tax was the objective, then perhaps pension's not the right thing to do. But the other planning rules around pensions still apply, so funding for the future. And it also provides a tax incentive, a tax efficient way of getting money from the business, so may play a part in a kind of wider strategy. So looking at inheritance tax as a whole, so this would include pensions and APR, BPR qualifying assets. I think generally speaking, if you have an inheritance tax issue, you have excess funds, there are 4 strategies you can apply. The first is to spend that excess money. And I don't say that glibly. I mean, enjoy it. If you are in a situation where you have excess funds, then, take the additional holiday, fly first class, treat your kids, treat your grandkids. I think enjoy life. Again, that comes with a need for proper planning to make sure that you don't run out of money. But that is, I think, the funnest way to get rid of an inheritance tax problem. And if you're not sure about spending, I'm not sure I can have another holiday this year, think of it as getting a 40% discount from the taxman. You could invest it. Traditionally, that was BPR and APR qualifying assets or pensions. You can gift funds away. Again, similar to spending it, once they're gifted as a settlor, you can no longer enjoy the benefit of those funds. So gift it responsibly, with proper planning, insurance to make sure that you're not going to run out of money, or you can insure against it. And I think with life insurance, that's one strategy we can be fairly confident is always going to apply. Because if you have a life insurance policy, you are raising funds to pay tax. From the revenues point of view, they're still getting their tax hit, so unlikely to be tampered with. As I said there, the gift it can be direct gifts or can be gifts via trust, provide different levels of control, but the premise being that as the person giving the money away, you can no longer benefit from it. And of those 4 options, sort of beyond the £1 million limit, your options to invest it is sort of gone. And I suppose that was probably the option that was more of a silver bullet type, was more transactional, was more have a lump sum of money. I can put it over here and my IHT problem goes away. That no longer applies. When I talk about gifting responsibly or spending responsibly, I think it's really important to have some kind of idea of what finances may look like over time. So engaging with a planner can help with that. This is an example with limited gifting. The green bars and the blue bars, that shows the value of an estate, value of a couple's assets over time. Age 65 on the left, all the way up to age 99 on the far right hand side. And what I'm saying is that if you have a large amount of money and you haven't really got a strategy in mind, you might sort of think, well, I've got an inheritance tax problem. I'd like to do something about that, and I would kind of like to help the kids a bit, but I don't know how much I can give away without running out of money. So I'll just give away a little bit. You can see you give a little bit away and the value of your assets goes down. And then a little bit later, maybe 7 years later, maybe age 75, you might sort of think, do you know what, I haven't run out of money yet. I might sort of give another small gift. So give another small gift away. And then the value of your estate kind of carries on for the rest of your life. And in this example, it's still a sizable estate at age 99. So potentially still a sizable inheritance tax problem that could have been avoided with a more structured, more informed gifting strategy. So this is an example of how that might look. Making a significant gift, having done a model like this to project what the impact is on your assets over time, and a smaller gift later on, which means that you don't run out of money, you remain solvent through retirement and the later years of life. But at age 99, there's still some funds there, but they are within the allowances. Now, in practice, you might not do it like this. I'd sort of put this graph in for the sake of illustration, really. It is possible to make large one-off gifts like this, perhaps not the most effective way to gift, or maybe the most uncomfortable way to gift, because you're giving away a large amount in one go. But I hope it illustrates the point that having some certainty, having some assurance that you can give a large amount of money away via whatever method, and still be solvent for the rest of your life can help improve an inheritance tax position. Okay. And my final slide was around the final strategy I mentioned. This was on inheritance tax. And to say that inheritance tax can be can be taken out on a whole of life basis, as the name suggests. That means that the insurance will stay in place for the whole of your life, for as long as premiums are paid. If you had a couple with an inheritance tax liability of £200,000, so they are £1 million over the relevant limit, they can take out a whole of life policy to pay out on the second death. And in this example, it's going to cost them £368 per month, which is a relatively high amount on a monthly basis. In the context of a benefit payout of £200,000, it might well be worthwhile, but still accepting that generation of income is still an issue for many people, even if they are asset rich. So you could also have what's known as a reviewable policy. This is much cheaper, much more affordable. Reviewable is a bit of a misnomer. That means that the policy is reviewed after 10 years and 5 years thereafter, which means the cost goes up. So you'll see at the top of the slide, it says buy some time. You can use this type of strategy to buy some time if you want to undertake a kind of wider gifting strategy, spending strategy, whatever it might be. But you have an inheritance tax liability for the 7 years post-gift. Then taking out something like a reviewable insurance policy alongside that buys you some time, or buys the estate some time, where if the worst happened and you were to pass on within 7 years of making a gift, the insurance pays the tax liability, and after the 7 years or after the 10 years, you cancel the insurance, and those assets have been gifted or spent but are outside of your estate. Thank you. That was me, and I believe it's now over to Marketta.
Thanks, Tom. So we've already heard that this budget brought some changes in capital gains tax, and these changes perhaps are not as bad as were some of the predictions. And we will also see some fairly substantial changes in inheritance tax. So Tom and Steve already covered some mitigation options, and I will add to the list And I'll focus on the exit and succession strategies, as these are now going to be even more important than they were before for owner-managed businesses and family businesses in particular. So I will run through these on the back of a case study to make it a little bit more interesting. Can I have a next slide, please? Okay, so meet Alex. Alex is trading through a company. So she built this company from scratch. It's now worth £3 million. So because she built the company from scratch in terms of capital gains tax, it means that the shares she has in the company have trivial base cost, and to make life easier for me, she already used up all her BADR allowance on somewhere else. So Alex now wants to retire. But if she sells the company, she'll need some income. So in that case, she would want to reinvest the funds in an investment property, and she would be doing this via a company again. Now, I have quite a lot to cover, so I'm not necessarily going to talk about everything on the slides. So please feel free to contact me afterwards if you have any questions. So let's go to kind of scenario one. So this is really a simple case where if Alex simply sells the shares, she will pay CGT, and then she can take the net proceeds and invest them or insert them into a new company, probably as a director's loan account. The company now has funds to invest in a property, and Alex has director's loan account. She can draw on income tax free. Now, in many cases, this might be actually really quite efficient scenario, but to talk about some alternative options. So if we make a little tweak, so now Alex owns her shares in the trading company via a holding company. So it's the holding company who is selling the shares in a trade co. So a company selling shares in a trading company generally can often benefit from a substantial shareholding exemption, which is a relief not available to individuals. If we qualify, which in this case we do, there would be no tax payable. And the holding company therefore has the full 3 million proceeds to reinvest, so there is more cash to play with. Potential disadvantage for Alex is that she doesn't have this DLA to draw on tax-free, which might or might not be a problem depending on circumstances. So a sale out of corporate group could be potentially a first step to set up a family investment company. So I will talk about this really briefly. So family investment companies, it's not a company, it's not a specific structure. We are talking about very wide range of different company structures. But what we're talking about is a company which exists for a specific purpose, and it exists to serve needs of a specific family. And generally what we are trying to achieve here is to allow the old generation to retain some involvement and potentially some income, but also pass the value and potentially some income down to their children or grandchildren. So as I said, we have lots of options on how to structure this. Typically the shares would be spread between various family members and possibly some family trusts as well. For example, if we have minor children, we really wouldn't want them to own any shares directly. So family investment companies has quite complex planning, large number of legal tax consideration, but it can be an effective estate planning strategy in some circumstances. So I'll move on to a next slide. So here, if we tweak our scenario a little bit and say Alex's children are involved in her business and they want to take over from Alex and carry on trading. So Alex still needs cash going forward, and the children don't have 3 million laying around to pay for the shares. So quite often this would be resolved quite tax efficiently by employing a transaction structure where the children set up a new company which acquires shares from Alex. Alex receives some cash, but majority of the value is usually rolled into loan notes or redeemable shares Alex, the new company issues to Alex. And the key advantage of that structure is that the children don't have to pay anything. So effectively how it works is that the consideration is funded by cash held in the original company and by any future profits of the original trading company. So the current value of the business is still in Alex's estate. However, any future growth is now outside of it, so it has that benefit for the estate planning as well. So moving on, another slight tweak. So say that Alex has other income stream, and she can actually afford to gift the shares to her children for free, and that's what she wants to do. Now, the default position is where we gifting assets which are subject to CGT rules. The capital gains tax is normally payable on market value. Now, if we are gifting shares in a trading company or trading group, the entire gain can be potentially deferred into the children's shares. Now, the gift relief is also available for other business assets, not only shares. So, for example, trading premises used by sole trade would be covered as well. There is no inheritance tax payable immediately or ever unless Alex dies within 7 years from the gift. So there again, there would be some benefit for the estate planning there. And now, potential problem where we're gifting shares could be if the business also owns some non-business or investment assets. And if that's the case, that we will probably see our holdover relief restricted. That if goodwill is involved, then there will be slightly different outcome whether we have new or old goodwill. Now, when I'm talking about old and new goodwill, I mean pre-2002 and post-2002 when the rules changed. We will have a worse outcome with the new goodwill than the old goodwill. So in this scenario, we are ending up with almost £300,000 to pay. So what could we do with that? So one way how to mitigate that would be to demerge the investment asset first. So there are many ways to split a company into two. Many different transactional structures which can achieve the same thing, but most of those transactional structures will come at a high tax cost. So when we're talking about corporate demergers, what we mean are very specific transactions or transactional structures which are designed to achieve this split tax efficiently. And these utilize a wide array of reliefs and exemptions, and they can be very tax efficient, but this comes at a cost of complexity. So the demergers are multi-layer, multi-step transactions, and they're quite complex to implement. So back to the example, so we can split the company into trading side and investment side. There would be no tax payable, but implementation costs must be considered. As I said, there are complex transactions. So as a result here, the Alex can now gift her shares in the trading side completely CGT free. And if she also wants to gift the investment side, there would be some capital gains tax payable, but it is considerably lower than it was in the previous scenario. So this example is showing use of demerger to separate trading assets from investment asset, which is one of the common uses of demergers. Another common use would be where we have multiple shareholders who want to go their separate ways, for example. So the only item I haven't mentioned in the initial list is the business asset rollover relief. So that's not available for shares, but it is available for other business assets. They can be owned by individuals, so partnerships, companies. It's available for all of those. And the principle is that if we sell a business asset, we can defer the gain we crystallize into a new asset we acquire, and the new asset has to be acquired either 1 year before the disposal or 3 years after. So that's a very brief headline on that one. Now, all of this comes with a standard warning. So can I have a next slide, please? So all these strategies and reliefs are subject to conditions, and they can be quite complex. There can be multiple taxes to consider, so proper advice is essential. Also, the tax obviously is only part of the consideration. There are many of commercial aspects to take into account, which are equally or even more important than tax. So hopefully I've shown that we have a number of tools in our toolbox where it comes to exit and succession planning. So none of these are one-fits-all strategies, and in every case, individual circumstances, needs, mid-long-term plans, etc. It all has to be considered to find the best solution for any particular business or particular individuals. And that's all from me, and I'll hand over to Steve again.
Thank you, Marketa. With only a few minutes left, I will cover a few other things that were mentioned in the budget. These are sort of headline grabbers again, in terms of where we think there's going to be impact on a wide range of individuals and clients that we act for. Double cab pickups. So a rather unfortunate situation where these type of vehicles incredibly popular in the rural and ag world, as well as sort of manufacturing civils world. You might remember last year HMRC updated their guidance overnight to say that these double cab pickups with a payload over 1 tonne will now be a car and taxed accordingly. Huge uproar followed. There was a U-turn the following day. It turned out that no one had actually told the revenue to release that guidance. It all happened by mistake. We've now got a U-turn on the U-turn, which is a really disappointing situation for many. So from April 2025, double cab pickups will be treated as cars. That will apply for new leases and new acquisitions from that date. The detail in terms of what HMRC have described as transitional provisions for benefit in kind taxation for individuals employed, it is simply transitional provisions is all that's been said. We don't know what that looks like. We can't really guess at this stage whether that means that people who've already got the double cab pickups will be taxed to a full benefit in kind from April 25, possibly a partial one. I think the date to which all existing double cab pickups will be brought in line to new ones will be from April 29, I believe. So we will keep you updated of what happens there, because I appreciate that is a very wide-ranging announcement that will have very many tax implications. So that's pretty bad news, really. Unsurprisingly, HMRC and the government need to replace all of the fuel duty because of the gradual fleet replacement to electric cars. So electrics are just becoming less tax efficient than they were initially. The benefit in kind rate is scheduled to increase to 9%. It has been 0% for a very long time. And hybrids are sort of more closely lined up to internal combustion engines. Another piece of nasty news was the rate of interest that HMRC will charge on late paid tax. I think HMRC are probably the backlash of being the unwelcome label that they would describe as a cheap line of credit by not paying the tax. They will now charge interest at a base rate plus 4% as the standard rate for late paid tax from April 25. So, really do pay your tax on time if you didn't already. Stamp duty, land tax, further charges and surcharges on companies buying residential property, depending on what the property is used for. Certainly anything over £500,000, if not used for a right purpose, has got a huge rate of 17%. If that company happens to be non-resident, it's 19%. The additional surcharge is 5%. So really do take advice before you buy a property if you're not going to buy a plain vanilla only home. And we have an SDLT team that can help you with that, because the SDLT rates are getting pretty penal now. The final other two things to mention, R&D and patent box weren't mentioned really at all, remain very valuable if perhaps R&D is very much under the microscope, but the subsidy for carrying out qualifying R&D activities around about 15 to 16% for periods starting from April 24 under the merged regime, slightly different for intensive businesses and possibly losses, but also patent box for corporates. If you have any patented products, you can actually reduce your 25% standard rate of tax to 10. That is a whistle-stop tour of the other budget matters that were raised. As I've said, we're not intending to sort of cover all of the detail on the fact changes, which I'm sure you've already read about. Okay, we've slightly overrun. Thank you everyone for dialing in. Hopefully that was useful. Please do get in touch with us if you have any follow-up questions. We'll be more than happy to help you.